Hello, I'm Dave Hightower from the Hightower Report based in Chicago, and today I'm going to discuss the global soybean production, supply, and demand outlook in a very historic time in which we have a lot of historical supply and a lot of historical demand changes that we have never seen in history. So I always like to take a top-down approach where I look at the big picture and figure out how those impacts are going to influence grain prices and grain consumption. And as we have seen in the last 10 years, the importance of oil pricing, crude oil pricing is extremely important to all commodities, not just from the cost of production, but there's a lot of fund money that decides when to invest in physical commodities by what the signals are in the oil market. Now, we've recently had a mass destruction of demand from the virus in which everything was ground to a halt. And oil prices fell even into negative territory. And so now we're attempting, as of this date, we're attempting to find out what is equilibrium. And equilibrium pricing in crude oil is likely to be north of $35. And the reason I say that is because a lot of production in the U.S., which has become the marginal and producer of last resort before the crash, that's where another layer of U.S. production becomes profitable and not profitable. So that's a level that we need to obtain in order to bring back enough oil, I think, to survive, supply the world what it needs. Also, we've had in the short term now a tremendous amount of stimulus, $20 trillion in stimulus, and the U.S. deficit is going to explode. And central bankers around the world are doing everything that they can in order to stimulate inflation. Right now, they would love to have inflation. Economists say it's not possible. It's a highly unlikely, depending on which one you talk to, but that's what the central banks are gunning for. They're attempting to get that. So the U.S. Central Bank is going to go beyond what it needs, and until the world indicates that the U.S. cannot borrow more, they will continue to throw fuel on the fire in order to get some kind of recovery going. So when we do find out that we're recovering, we have very low energy prices. And in the past, the U.S. economy, every $10 lower in crude oil pricing was like adding 1% to the GDP. So just think of that as we go forward. Also, coal and fossil fuel, they are going to be gradually edged out as we go into the future. So that will require some new and higher cost fuel source. If you if you look at the historic correlation, I have an image of soybean oil and crude oil pricing here, and it shows you there is a tight relationship between these two markets. And you can actually see that soybean oil tends to move in advance of crude oil, which is quite a surprising relationship, but very close. And now that I think oil prices are rebounding, I think you're going to see commodities in general rebound. If you look at some developments that may happen this year, you look at shipping. Nationally, we've come from a level where bulk dry shippers have not been able to make any money. They're at a virtual standstill. South America was the choice of supply for China and soybeans, and so therefore their shipping rates have firmed up for the world here. We have a little bit of seasonal demand for softer pricing for bulk in the near term, but I think that's also going to see U.S. rates are going to fall because of the dollar. And the reason I say that is because the dollar has been a safe haven harbor, and we have inflated the dollar dramatically. And as we go deeper into 2020, if there's a vaccine, if there's treatment for the virus, then there will be less and less need for holding money in the U.S. dollar, and we're going to see investment move to other areas for with a more attractive yield. The Chinese trade commitment is another important development going forward for the shippers. I think we've already seen a little bit of U.S. China posturing ahead of whether they will fulfill this trade obligation, but I think they will. The U.S. has acted overly harsh to begin with China because of the virus. That other countries are joining in that, and so China, for political reasons, will have to make sure that it is somehow soothing trade relations because it doesn't want trade and political problems as we get toward the end of the year. The change in the IMO emissions regulations also an important point, and the reason I bring that up is because we have a dramatic oversupply of distillate fuel. Distillate fuel was the worst case product market for oversupply through this crisis. And why? Because of the absolute reduction in jet fuel consumption. So that should keep shipping rates down as we go forward. But I do think we'll see higher South American rates than pulling up U.S. rates. But keep in mind the recovery probably in these shipping rates will probably be lower than what pre-crisis levels were. If you look at this chart, you can see the Baltic Dry Freight Index, extremely cheap historically. So we're back to these kind of 2009 depression type pricing. And so if you look at other shipping rates into Japan, I think it's important to realize that the Japanese yen is also likely to fall precipitously ahead. So shipments from the U.S. into Japan will see that benefit of the currency. The next slide here shows some of the different shipping rates between the U.S. and various parts of China. And again, this could be as the U.S. becomes the primary seasonal supplier, then these rates are going to be more important going into the late summer and fall. Here's a chart of soybeans relative to history. And again, we're down now to depression type of pricing. We're down to demand destruction type pricing. And if you look at this year's 2020 USDA supply and demand report, you see if you put a normal yield, a trend yield on the U.S. crop this year, we'll certainly have a adequate supply, but we have shifted from a dramatic historical oversupply in prior years now, and you look at the yields that I put on here, if you put the trend yield and slightly lower yields from that, and you get down to a level where it doesn't take much of a yield reduction in the U.S. to result in a very tight stocks to use ratio. And I would like to continue to make that point that it's not important how much global supply we have in terms of metric tons, it's how fast are we using it. And the next slide shows you that U.S. soybean ending stocks, while we're still at a relatively high level compared to the last year in absolute numbers, if you look at the stocks to usage ratio, and again, that's an average, that's the middle point of a decent crop, that we're still going to be tightening this market relative to past years. As we can see, the world soybean ending stocks figure is high in a absolute amount, but we have seen the beginning of a shift away from those extremely high stocks to usage ratios. So we're coming down from what was that record pipeline supply, and we're going to be getting into a more normal marketplace. So going forward for the U.S. crop, in addition to sitting today with market expectations for large acres in South America and good weather and yields in South America, we have the U.S. entering the growing season. And so we have a lot of we have no weather premium, I guess is a better way to say it, into prices at the current time. And if you go back, you can see some of the breakdowns in terms of the actual numbers. So ending stocks are now down from 580 million. So we've come down from that extremely high amount. And so if you go forward into the next outlook for yield, you can see how the yield variability in the U.S. on this trend line yield chart has shown some variability. And so what we have is historically, you go back and look, this is a 2018 soybean price chart. And I see this year's supply and demand figures and the early setup very similar to that. And so we had record world ending stocks of soybeans back in this time frame, but yet we're sitting here 40 cents below the level in which we had record supply. So I would suggest that 40 cents is a some kind of deflated price pressure because of the coronavirus crisis. So going forward in the soybean oil, we see historically cheap oil. We see that correlation, though, as I indicated, with crude oil. And so part of the cheapness in oil has been the result of petroleum prices going down. Certainly, the virus concerns destroyed demand in energies and for food. But I think as we're going forward here, we're going to find out that when you have ag prices down below the level seen in 2007, so I view those 2007 through 2009 price levels as the last time that we had a depression fear. So we're now back to those levels in which we are anticipating and pricing a depression. So if we don't have a depression, then you're going to see a reversal in prices. You're going to see an improvement in demand. And I think coming out of this, we're going to see increased concern on food security issues. Where did it come from? How safe is it? What's the quality? How confident am I that I can get the delivery of that? And plus, how much volatility will I see in the currency to purchase that particular commodity? So I think demand's going to recover. We don't have any premium of weather in the price. And I think that we are cheap to relative other vegetable oils. So there is financial pressure on U.S. farmers, but they're going to continue to produce aggressively. They are well capitalized, and we're going to continue to push an export policy, and we'll support our farmers. And we've recently shown support for them. So they will be in the fields, and they will be putting all of that husbandry into the crop. So if we look at soybean oil, obviously the quality of soybean oil over palm oil from a dietary standpoint is well known. But when you see such low historic prices, when you see the total input of either whatever form of oil you're going to utilize in your food being so low, you can afford to input the better quality oil into the product because all costs have come down dramatically. Maybe not consumer prices coming down as gradually, but certainly the input, the raw material costs are down. So if we have any problem with weather, and particularly with palm production, that's going to support both palm and soybean oil prices dramatically in the year ahead. Now, we cannot discount China and India. They are major consumers. And if you look at charts of their production, you find out we run a tremendous shortfall going forward. Argentina is also a major supplier. Their currency, in my opinion, looks to possibly appreciate maybe 15 or 20% in the next 4 months. So that's going to make a price differential unfold there. And this chart is a world vegetable oil chart, which shows ending stock. So here's a situation where soybeans are not as tight. They're coming off of historic levels, but vegetable oil on a use basis is tremendously tight. So that's why we can ill afford to have any kind of a weather situation coming down. There's the Indian veg oil. Look at the gap. Look how much they produce. Look how much they consume. Look how much that they produce. When you go into the feed, we're coming off a historical situation also in the feed area in which we have a shortage of world protein because of problems with disease, ASF in the Chinese pork, and in other parts of the world, we've seen a dramatic setback. And then in the US, we've seen a dramatic reduction in production because of processing plants were shut down because of the virus. So we have a 1-2 punch that is really set up over the last 2 years. And now we're going to have to ramp up world production in order to meet that supply. And I also think there's going to be some significant changes in China, primarily a fresh meat consumer. And now, since they had to go into frozen storage to during their crisis to provide food, I think that the tastes are going to change in China. that there will be more of an appetite for frozen, which means that opens up business for other countries shipping into China. And they're going to be very aggressive in trying to expand their herds. And as you can see from this chart, the beef price chart has really exploded. And so there is potentially a major change in all prices beginning to rise for some of those inline protein products. China feed's also going to be surging in the near term as they attempt to get back to that domestic level that they feel comfortable with. But as opposed to 2 years ago, when the livestock producers were not profitable and feed demand was down, now we're back to a point where feed demand is going to begin to come back, and that increases the potential for higher prices for those buying grains for food products. So the agricultural stuff is certainly of importance, and you can look at the numbers when it comes down in the livestock areas. These tremendous numbers are going to expand dramatically. It's going to increase the amount of competition. We will need to see these replacement demand elements in the soybean market and in soybean oil in order to overcome what has been lost in terms of biofuel demand. So I see prices going forward in the grain markets is probably 40 to 50 cents too cheap as of the middle of May, looking for a normal macroeconomic reflation back up to that 30, 40, 50 cent level. And then I see going forward any kind of disruptive weather, and at this point it might be too much rain in the US, any disruptive type of weather will begin a long, slow grind higher in prices. Fortunately, there is enough supply and demand is going to be consistent, so the price structure probably in a slow, gradual climb for 2020. That's my update for 2020. Thank you.